Global financial markets are experiencing a burst of optimism. With a potential peace deal in the Middle East, international trade routes are flowing again. Crude oil prices have tumbled. For energy-dependent economies relying on these tankers to fuel their growth, cheaper oil provides immediate, much-needed relief. This has triggered a sharp spike in Indian equity. Stock indices are climbing, and bond yields are dropping, creating a temporary sense of security. However, the underlying indicators remain strained. Foreign direct investment is spluttering, and inflation is rising, even as the markets rally. Market sentiment is transient. It doesn't provide the long-term capital required for a nation to move permanently beyond the low-middle income bracket. The broader reality is that the global economy is entering a supply-constrained regime. We are facing a significant global shortage of capital. This chart highlights the coming demand. By 2026, energy grid investments will require $3.4 trillion, and AI giants will spend $700 billion on hardware. As global demand for money increases to fund this infrastructure, the cost of borrowing is rising. Central banks, including the ECB and the Bank of Japan, are already signaling higher interest rates for the long term. For India, this capital crunch is a direct threat. To maintain its growth rate, the nation must find a way to secure large-scale, affordable funding before the global supply tightens further. India sits on a substantial stockpile of wealth, but there is a disconnect between the worth of its sovereign assets and what they actually earn. Look at the logistics sector. The Indian Railways moves 1.6 billion tons of freight annually, and the national highway network now spans over 146,000 kilometers. There is also underutilized potential in the space program. ISRO executes missions with unique cost efficiency, yet its commercial revenue remains small compared to its technical accomplishments. India Post represents a similar opportunity. It has 162,000 physical offices and holds 15 trillion rupees in savings. Yet it operates largely as a traditional mail service rather than a commercial banking giant. If these entities were reorganized and valued at commercial parity, their combined worth is estimated at $300 billion. The resources exist. The challenge is the lack of an institutional mechanism to deploy this wealth toward national growth. Full privatization is rarely the answer. It creates political friction and raises valid concerns about the public purpose of these essential services. A structural alternative is to keep the government's majority stake at 51% while transferring additional equity into a single vehicle. This pools fragmented holdings into a consolidated financial powerhouse, the Amrit Kaul Fund. Control stays with the state, but the capital is pooled. By listing this fund as an ADR on the New York Stock Exchange, India can directly access global pools of institutional capital. This architecture is designed to transform passive state infrastructure into a liquid, globally traded asset class that attracts the long-duration investment India needs. This fund targets patient investors, like the pension managers in Singapore, who seek diversified exposure to the Indian economy. The influx of capital has a specific purpose. The proceeds can be used to retire existing public debt. Shrinking the deficit frees the national balance sheet, allowing for a new generation of investment in energy grids and modern transit. This window is closing. The current optimism in the markets will fade as the global race for energy and AI infrastructure accelerates. Escaping the middle income trap requires institutional boldness. India must mobilize its public assets through dollarization while the global supply of capital is still accessible.